5 mistakes investors make with ETFs. Well, I want to say in the beginning that ETF is a diversification. Its idea, the core idea of ETF, is making your portfolio more diversified. By a single time payment, you're buying a bunch of stocks. And for investor, diversification means safety. So by buying ETF, we want our portfolio to be more safe. And with that things in our minds, we can start discussing our 5 mistakes. So the first mistake when investing in ETF is basically not knowing the history of ETF, which should be quite long enough. We are buying an ETF, and ETF is a product of a certain company. It may be a Vanguard or iShares, and it doesn't matter. The thing which matters that the history of the company should be long-lasting, we should know the founders, and we should at least understand that the company we're investing in is reliable, stable, and we can delegate our investment to a certain company. The second thing which I mean by knowing the history is basically checking the average returns for that specific ETF over a long-term period for the past 1 year, past 3 years, past 10 years, and since the inception of the ETF. What does it mean? The average return for all that long period of time means that all worst and best cases scenarios that have already happened to those companies in this ETF already included in this number, and this is pretty much the number on which you can rely upon. And one more thing here which I want to mention is you should in perfection know whether the ETF you're buying is actively or passively managed, because if it's passively managed, then it's simply following a certain index, and we already know the ideas of different indexes, and we can freely check what companies are inside that index. But on the other hand, when the ETF is actively managed, this is considered more risky way, because active management means that behind the ETF there is actually a real person who is thinking on which stocks to buy to a certain ETF, when to do that, and in what percentage to the ETF, which is reducing the control over our investment to that ETF. The second common mistake which people make investing into ETF is not knowing the composition of the ETF. And by that, I mean the safety or the diversification. And diversification by countries, diversification by sectors, and by single companies. When we are talking about diversification among countries, we should understand whether it is a US market or international market, and what is the percentage of exposure to that or this. And we should also understand if it's developing or emerging market, which is kind of important for the risk factor for our portfolio. And by sectors, I mean that if we're buying a broad market ETF, that we want to check so that all of the sectors, 11 sectors of the economy, are presented in that specific ETF in a proportions which pretty much represent their size on the market. And if you're buying an ETF for a specific sector, well, that may be the case when, for example, our portfolio is lacking of some sector, then we may buy ETF for a different sector. And in that case, we want to make sure that that specific sector will represent 100% of that ETF. And what I mean by diversification among companies is you have to check the total number of the stocks in the ETF, and to check at least top 10 largest holdings, and check the percentage of that top 10 largest holdings, which is usually displayed on the page of every ETF, and to see so that that percentage is not too much, like 20 or 30%, because if the percentage of top 10 holdings in relation to the total ETF is too much, then you can understand that these companies will have very big influence on your ETF and as a result on total portfolio, which comes aside from the idea of diversification of the ETF and for the safety of our portfolio. The next thing I want to mention here as a mistake is when people are buying ETF without actually knowing commissions, fees, and expense ratios that this ETF charges. And the thing here is it's open information, and in most websites this information is clearly listed. But the thing you have to understand that there may be ETFs for a single index, for example, Vanguard VOO, ETF for S&P 500 index, and iShares IVV. These are ETFs for the same index, but the expense ratios for them may differ, and this is what I'm talking about. And you have to understand that this commission is taken every year and from the amount of your total investment to this ETF. And sometimes it may seem that very small percentages like 0.01% will not make much difference on your investment portfolio, but the thing we have to understand here that these companies which are issuing the ETFs, they make really big fights for each tiny bit of the percentage of their expense ratios. And we have to understand that actually a tiny bit of that percent will make a pretty significant difference on our returns over the long period of time. And one more thing I want to mention here is that you want to get to know whether your ETF that you're buying is paying dividends or not, because this will make a difference when you will pay your taxes. Because if you don't know whether your ETF is paying dividends or not, I don't want this to be a surprise for you when you receive a message from your broker that you've received a tiny bit of dividends from a certain ETF that you did not expect, so that later you have to pay taxes for that small bit of dividends. On the other hand, there are ETFs which are not paying dividends and which are using these tiny bits that they could pay to you. They are actually reinvesting automatically those tiny bits into their ETF, which is more tax efficient and which I would recommend you to check later if your ETF is paying dividends or not. The fourth common mistake which I want to mention here in this video is quite obvious. And this mistake is active trading with ETF. Now, if we go to the beginning of this video, I clearly mentioned that ETF equals diversification equals safety for the investor. So the idea of ETF is to be more diversified and thus reducing the fluctuations of your portfolio, reducing the volatility of your total portfolio. And even if you like to do a day trading, which I do not actually recommend you doing, but if you want to do that, then doing this with ETFs is quite a bad idea, because when you're buying a single stock, its volatility is bigger than the volatility of 500 different stocks, because then you'll get the average of those. And I just want to let you know that making money on the day trading of ETF is not just against its core idea of the ETF, but it's just a useless thing to do if you can do that with a single stock. And the last thing I want to mention in this video as a mistake is not realizing the long-term effect of the ETF on your portfolio. Because when you're making the decision which ETF to buy, you certainly want to make sure which asset classes are growing more, which sectors are growing more, and which economies in the world and countries will give you more return or more safety and diversification. And with everything I listed above in this video up to here, you are probably now having the idea what will be the effect of the ETF on your portfolio. And one more thing I want to mention here is when you're buying ETF, you should know what is the percentage of that ETF related to the total amount of your portfolio, and what will be the effect if you're buying that ETF in the long term. So these were 5 mistakes that I mentioned in this video. I hope it was useful. You found something new for yourself. Please like this video. Thank you for watching.